is Main Street Asset Management CIO Aaron Gibbs and the Fitz-Gerald Group Principal Keith Fitz-Gerald. And Keith, I want to revert back just for a moment to that live report we just got from Max Gordon. You talk about how thoroughly disgusted you are by big names, State Farm, Allstate in particular, canceling policies on homeowners over not just the last year, but over several years. You say that there's an extreme dividend risk to this group. Keith, what are you watching?
It is. It's going to be anybody that's involved in the property casualty business, because situations like this are going to roil cash flow. They're going to roil revenues. I mean, many of these companies are going to try to avoid or skirt the obvious, but, I think there's going to be federal backlash. I think there's going to be state backlash. If I could short the whole lot of them, I would.
Yeah, well, again, state-regulated companies. We're going to get into this story, of course, later on in the show. Aaron, I was just talking about those yields. Your focus is on the U.S. dollar compounded by these higher yields. What do you make of the 10-year pushing that 5% mark? Many have said that is a big red flag for them, and that could be the true markings of a correction.
Absolutely. I think looking at this coupling of both the sell-off in equities as well as treasuries is important. Obviously, it's all about what the yields are going to do. I think we are, as the year moves on, we'll see more of a decoupling where we see the bonds and the equities move in different directions as more traditionally known, certainly as we're still waiting for those cuts. But I think this is in that 5-year percent, really, we should be getting used to higher yields for longer, that it is going to be more expensive to borrow for longer, and that expecting these rates cuts and going back to a zero rate environment, we really need to get that out of our minds.
Yeah, and the concern, Keith, is consumer borrowing, the housing market, the mortgage rate story, which, we're now looking at the commentary from the NBA Senior Vice President, Mike Frantoni, and he says this data we got today, the jobs data, a pause in cuts is a lot more likely now, and this is going to push mortgage rates higher in the near term, Keith. And even though you say that it's tough to know which way the wind is going, you do make, I think, a very interesting comment about Janet Yellen, that her recent commentary about inflation was a, quote, joke, and that you didn't think it was possible to top transitory, but she managed to do so.
She did. And to Aaron's point, I think this is going to be a tipping point, a balance point. I'm still expecting a net positive this year, but this rise in rates is going to make it more expensive to borrow, not just at the consumer level, but the big traders. That's what this sell-off is all about. They don't want to have the equivalent of a margin call at their level. So they're just hitting the books, jettisoning everything. They're going to let it settle out. And then I think we're going to get back on the gas with the big trends of our time, the AI, the data, the money, the movement, the healthcare, all of those things I think are still net positive longer term. Short term, not so much.
Well, and Aaron, you do talk about a correction in your research note, and you also say that this is a time where you're looking at your technology stocks holdings, and it might be time to do a little selling.
Absolutely. And please don't wait any longer. Take those gains. Trim now. Don't regret later. We've seen tech stock weakness for the past 3 trading days. There's definitely a lot of headwinds when it comes to tech stocks. When you look at their valuations versus what growth that we're expecting, they're trading at about a 30% premium to 40% premiums on valuations, but their growth is the same as what we're expecting for healthcare and industrials. Right. So you're not getting paid for owning these stocks. And I would say they're really priced for perfection. We've seen some weakness in Europe. We've seen that strong dollar being another headwind when it comes to multinationals. I'd really recommend taking some risk, and let's get back into diversification.
All right, but if there is a pullback in some of these big names, Keith, is that the moment when you pick up a little Palantir? Maybe you pick up some Nvidia.
Well, I've been shopping all week. So, respectfully, I'll take the opposite side of Aaron's coin here, because I think that my perspective is probably a little different. I'm going to look at this as an opportunity. The markets are the only store on earth where people fear a sale. I'm not concerned about the valuations. I'm more concerned about lining up for that long term that I know is coming.
All right. And also, too, Aaron, when you've got that global story, that global inflation story, we're having a change in the political leadership here in this country. But other countries are having, they've got more economic problems than, frankly, the United States does. Does that affect your view of emerging markets and emerging stocks? Is that maybe another place where we need to maybe back out just a little bit?
Absolutely. That's a great point. Yeah, we're seeing weakness across emerging markets as well as Europe. And again, it's just another area where I think you're not getting paid for some of the risks. You really have to be country specific rather than just doing a broad emerging market, because there's just so much weakness and very high risks out there. So, I think within technology, I'd like to be a little more specific. Software services are some of the more vulnerable, also when it comes to crypto and security. Also, and I think where we see the greatest weaknesses. And maybe in the semis might be one of your safer spots within technology, but again, I'd like to say just take some money off the table.
Yeah, well, no, it's been a strong year. It's been a strong year. Real quick, Keith, before you go, if you look at kind of the general mood of the street right now, do you think that the banks are going to change the mood right now on Wall Street when those numbers start to cross next week?
That's hard to say because not all banks are the same. I think JP Morgan is clearly at the top of the list. Now, full disclosure, I do own it. I think they're clearly the one to own. Everybody else I'm worried about because I don't think they're going to have the numbers. And I may be surprised. I may be completely wrong. But, there's very clearly going to be leaders and laggards here. I think small, medium banks are still going to be a problem area for some time to come.
All right. Keith Fitz-Gerald and Aaron Gibbs, always great to see you both. Thank you so much for joining me today.